There's never been a better time to invest in decarbonization. We've been investing in climate tech for 10 years now. That's more than 70 companies. And, LPs are able to look at our record of what we say we're going to do, what we've actually done, and how well it's working. We love technology, but technology doesn't build world-changing businesses. People do. If you're building on the electrotech stack, you have an inherent advantage on cost of performance that continues to grow every year, even if you don't do anything about it. If it can't win on price and performance standing on its own two legs, we don't see it dominating a large global market. Another way of thinking about that is this a short-term hype and overreaction, or is this a long-term trend based on creating real and necessary foundational value?
I'm Hugo. I'm an early stage investor at Climate Club, and this is New Wave with Sarah Sclarsic, general partner at Voyager Ventures. Sarah, welcome to the podcast. Congratulations for closing Fund 2. Massive success and great success for the ecosystem as well. Look, I want to start with this. When you started conversation for Fund 2, what did you feel was different in LP sentiment compared to the first fund?
A lot has changed in the world in macro conditions in the last 5 years since we went out to raise Fund 1 since 2021. Some up, some down for both venture capital in general and climate tech, decarbonization. I think the perception and the reality is the biggest gap. There's a difference there, and the perception is that it's not a good time for climate tech or decarbonization amongst some folks who are reading headlines but not actually looking at the fundamentals. And for the people and institutional LPs who really think about a multi-decades time frame and do think about fundamentals, there's never been a better time to invest in decarbonization. And when we sat down really to write the letter that we wrote now more than ever, really announcing both the Fund 2, but also, really our thesis, what we're excited about, what we're investing in, what's working. We looked at the numbers on renewable energy, on solar deployment, on the cost of batteries, which has been continuing to fall precipitously, along with performance improvements. And we really were able to compare, just in a few snapshots, what was true about the world in 2021. A lot of good things for decarbonization renewables by the numbers, not just the vibes and the sentiment. And what's true at the start of 2026 in those 5 years. And the progress has been incredible. And we've also crossed some inflection points that, were very quietly hit. They didn't make global headlines for the most part, and they really should have, because that's the story that's changing the world. Just one of those facts is that the main way that people around the world use energy is now electric. That wasn't true 5 years ago. It's about 34%. So that dwarfs any kind of fossil fuel. And that inflection point only happened in the last 5 years, and that rate of electrification is accelerating. So the future is clearly electric. And when it comes to how LPs view the world, institutional LPs really think about deploying capital and about returns and about what's true about the world on a multi-decade timescale. And so what we were able to communicate is that the fundamentals we told them about and talked about 5 years ago, about the continuing performance improvement, cost to clients for renewables, both generation, storage, right? That's solar, that's batteries, that's wind, as well as what you can then do with that cheap storage, of course, electric vehicles and electrifying other devices. That is not only continuing to be true, but the deployment is clearly here and has passed the inflection point on cost, where vehicles that are being built and sold in the world are now default electric, just as one example. So, I think LPs could see that what we told them was true about the world continues to be true, even more so. And what we told them we were going to do as investors with their capital and with their trust, we've done exactly that. We've always been investing in the foundations of decarbonization in the economy, and our very first investment in 2021 was in critical metals production. So we've been very consistent.
No, I love that, and I think it brings a little bit of hope when the headlines are like climate tech is dead and no one wants to invest in climate, blah blah blah. But yeah, I agree with you. When you look at the numbers, the world is shifting quite rapidly. Um, just to close off that section on the LPs, but are there any learnings that you would share with emerging managers that are trying to raise a fund with within the climate environment kind of thing? So it doesn't have to be a climate label per se, but that we would have previously called climate tech. Are there any learnings from those people?
I think it's tough to be an emerging manager. It's a crowded space, and it takes 10
You've
years,
been through it. You've
right?
been through it.
So a lot of sympathy for and empathy for people who are, starting off telling their story, just like we have empathy for all founders. I mean, an emerging manager is a founder of a firm. And I think just like a founder of any business, why you? Why are you uniquely positioned? Not just to see an opportunity, but to execute on it. And so for an emerging manager, a lot of what LPs are going to want to understand is not just what's your view of change in the world and where you see opportunity, because presumably if it's that big an opportunity, other people see it too. But how are you going to get there first? How are you going to spot the business models and the technology types that really are positioned to win? And of course, the brilliant founders who are um, going to break down walls to make sure that their company is a winner. So I think really telling the story about you and as an emerging manager, how you operate, how you go out into the world and find great ideas and find founders, what kind of networks, what's your approach. That's the crux of what an LP is going to want to hear about. Just like if you're an investor, you want to hear those same kinds of answers from founders. How do you do what you do? What makes you so good at it?
I mean, I'm gonna return the question. Why you, Sarah, and why Voyager?
Sierra and I have been doing versions of this work for our whole careers. Sierra Peterson, of course, my co-founder at Voyager. So that's about 20 years for each of us. Um, what that means is we have a few skills and depths of perspective that we bring to our work. We've seen multiple cycles. We built companies during Cleantech 1.0 successfully, leveraging business models like financing renewable energy deployments, not necessarily manufacturing at sort of low margins. So we've had a lot of time to see what's worked, what hasn't worked, and more crucially, why. Because every cycle is going to be different, but some of the core lessons about how do you build a business, how do you find and protect margins, those persist. Um, Backing up a little bit, I mean, over the course of those decades, more than 35 years now, Sierra and I have built 5 companies, all in climate tech, all in the sectors that we've always been focused on, um, quite successfully. That includes one public exit as a unicorn. We've crafted federal policy in energy and industrial policy and transportation policy. In Sierra's case, working on the energy and climate team back when we had one in the first Obama White House, and internationally on market design in Europe. Europe has always been core to our strategy, as well as North America. We've done graduate work at Harvard and MIT, central to the areas we invest in on electricity market design, on carbon removal technologies, among other areas. The rest of our investment team, also the majority of them, either are founders or bring advanced degrees in areas directly relevant to what we invest in, or both. And finally, we've been investing in climate tech for 10 years now, and decarbonization and industrial innovation. That's more than 70 companies. And, LPs are able to look at our record of what we say we're going to do, what we've actually done, and how well it's working. And so we're delighted that we've really had a lot of continuity in our LP base, and quite a lot of LPs have doubled down from Fund 1 to Fund 2.
Yeah, I would say from my perspective, it's not a surprise, but I guess it was still very hard work. But for looking at your portfolio, it's quite exciting for sure. Look, you talked about the learnings you've had as the founder, doing research work. I want to go back to the learnings you've had also from the first fund. It was your first sort of like official like institutional VC fund. What did Fund One teach you about investing in deep tech startups?
Yeah, I mean, I think it reinforced what we already know, which is that we love technology, but technology doesn't build world-changing businesses. People do. So it's really about finding that great fit between a technology that is inherently superior. It's faster to build, cheaper to build, faster to deploy, lower cost, but the team that's also sort of equally well positioned to bring it to market in markets that often are regulated if you're working in electricity, fast moving, right? Just like most markets that technology startups operate in. So founders who are equally adept at navigating that kind of shifting landscape and can stay true to their vision, but also adapt as things change along the way. That's probably not that much news to your audience, and I'm back grateful. Um,
But if we stop very quickly on that, as I said before we started, like I'm a student of this business. I'm only getting started as a VC investor myself. What makes a great team? What makes it
yeah.
unique to you?
Having a very clear vision, a big expansive vision that can carry you out for 10 years or more, which is usually how long it takes to build real core value worth billions of dollars. I mean, you're talking about real value that's potentially liquid, enduring. You could go public, you could get acquired. You're talking about actually achieving meaningful revenues, bringing products to market that dominate because they're just the best in their category, which means you've got to best all incumbents and all other startups, and really scale that in a reliable way that can continue to have a base for growth. So a team does that. A technology doesn't do that, and one person doesn't do that. And so for teams, we look at both that vision and that execution capacity. We look at, does the team respect each other? Like, why are they working together? Do they actually really enjoy the time with each other? I mean, this is a long journey. Do they respect that the other person knows more than they do about marketing or commercialization or technology development, and or are they really operating more from sort of ego or other places that are um, not as positive, but certainly not as effective in the long term? Um, they have to be able to raise capital. That's the reality of the world we live in. And, that's why I started off by talking about vision at the beginning. And we're early stage investors. You might have a technology, you might have a prototype, you might not. I mean, we also invest heavily in software. And so it might actually be closer to the people and the idea. And so what you're really selling is the vision that not just there's something worth building for the next 10 years, but that not only should we, investors, believe in that vision and that you can get there, but that you can also hire the best talent in the world to come on board with your vision and change what they were doing in their life to come join you, additional capital later on, customers, partners. That might be convincing a manufacturer that, you're a tiny startup, but you're going to be their biggest customer in 5 years and they should pay attention to you and work with you. So, it's not just about a splashy presentation or fundraising. It's really about, do you have a vision that other people are going to be inspired by, and can you bring them and coalesce them around that vision, but then also execute on it? And the last thing I'll say, because it is really important on execution, things change a lot when you're building a company from 0 to 1, right? You might think you know everything that's going to happen in the next 5 years, and I assure you, you don't. And that's fine. That's just life. That's reality. So people need to be, very persistent, but also very flexible about changing. And so what we look for that's very indicative of people's adaptability and learning rate is you make decisions quickly. You can't mull on a decision of, should we go into this product or that product first, or what marketing campaign we're going to get behind for 6 months or 8 months, because the market's going to just move fast, and it's going to move past you. So you need to make decisions quickly, and then you need to be able to learn from what worked and didn't work and adjust quickly. So it's more like tacking a sailboat. I'm not really much of a sailor, but kind of, as long as you don't necessarily need to go exactly the right place every single step, as long as when you get off track, you're getting back on track very quickly. And if you can make those decisions in days and not months, you will continuously be leveling up and getting closer to your goal.
It's interesting because you've talked about the vision being one of the most important things. What comes to mind for me is, like, you've been investing across the US and Europe. Do you see the same ambition in founders across both sides of the Atlantic?
We can, certainly. I mean, talent and vision are everywhere in the world. Certainly, it's more common to have a very sort of aggressively ambitious global-sized vision in Silicon Valley. The culture here, encourages that, and not just encourages, expects that. So, people don't aspire to build the biggest company in the Bay Area or the biggest company in California or even the biggest company in the United States. They want to build the biggest company in the world. And it's almost rare to find somebody who isn't planning that or talking about that. And it's common in Europe to, want to build for your home country or region, or maybe just Europe. Some founders, of course, from day one are always focused globally, whether they start in Denmark or they start in France or anywhere else. But it is also more common than we would see in Silicon Valley to really focus your business model around your home region.
We were talking about deep tech earlier. What are some of the assumptions that held up to your belief on Fund One? And I'm thinking that the narrative around deep tech is always it takes very long time to get to revenue. It's super capital intensive. Is that all accurate, or are there some stuff that you realize actually were just belief and didn't actually were accurate?
Yeah, it's absolutely no longer true. Um, and that is really exciting because the costs have dropped so much for everything from specific technologies like the renewables that are driving the cost of clean electricity, the batteries to store the electricity. You're talking an order of magnitude cost decline in the last 10 years for batteries, 90%. Fossils not coming down 90%. A 22% decline just last year. So every time these cost decreases hit a new inflection point, you open up new opportunities and new applications. This is happening every year. I mean, even on a monthly time frame, the cost of renewables and storage, that's such an incredible opportunity and a global story, and it is happening globally. Um, and so what that means is that trend doesn't sit in isolation. That's a very core capacity for the world to generate and use electricity, right? I mean, so much of what runs our life, the computers we're talking on now, of course, run on electricity, but increasingly so do our cars, so do our homes, so do factories, all kinds of other areas. And so that trend of falling costs, increased performance for electricity is overlapping and compounding gains from automation driven by cheap AI and much more capable AI. And again, that kind of progress is happening month to month and week to week. It's not even year to year. That gives you the capacity to control not just equipment that's manufacturing or operating like an EV or manufacturing lines in factories, but entire factories or entire networks of machines like the electric grid. So we're seeing these compounding gains from electrification and the cost and the components of electrification, automation, AI, and advanced manufacturing. So we can even build better materials that can enable new kinds of machines that we couldn't have before. Or that, for example, think turbines for power plants that can operate at higher temperatures because the materials in them don't crack or break. Or materials that enable better batteries that are fire safe, and now you can put them in your home and they store more energy and they're another order of magnitude cheaper. So it's really a materials, energy, and machine story. And again, advancement's not happening in isolation. It's overlapping and compounding, and that's incredibly exciting. So that didn't answer your question, but that sets the stage for answering your question. What we're seeing now is that the cost of building in the physical world and what you can do in terms of performance and cost versus incumbents that have reigned for 100 years, like the combustion engine in a car, is rapidly changing. That picture is moving so quickly. Already, we've crossed inflection points where you have such established supply chains for electric components and what's come to be known as the electro-tech stack, not just batteries, but the materials that go into batteries, the electronics around them, like inverters and electronic controls, sensors for all kinds of machines. That stack has built on largely the same supply chains and manufacturing lines and kinds of manufacturing tools that got us really cheap flat screen TVs and cell phones and other things we know and love, right? And so that Wright's law, these learning curves on manufacturing are continuing to drive progress. It means you can access components really cheaply, and they're cheaper every year. So if you're building on the Electrotech stack, you have an inherent advantage on cost of performance that continues to grow every year, even if you don't do anything about it. Um, and so ultimately, what that means is the old model of capex heavy central physical machines and manufacturing is actually a fossil based model, right? You need giant amounts of heat, really sort of dirty and robust equipment. That's not necessarily true anymore, and particularly if you're building an electrotech. We've backed companies that have, they're not based, of course, on fossil energy. They're modular, they're low capex. We've backed hardware companies that can outcompete any incumbent on price alone, price and performance. No subsidies. We don't back anything that needs a subsidy or green premium. And their capex is dramatically lower because they don't have to build, giant sort of fossil-driven centralized factories. And so they have an advantage on every part of the scale. In some cases, they don't build any capex at all. They can get there entirely with manufacturing partners.
Yeah, just to react on what you said, a couple of things that comes to mind. First thing is on advancement in manufacturing. I would advise people to look at what's happening in China. It's absolutely crazy, where you would see what they call dark factory, where there's not even a light on just because no one is working the factory anymore. And also on the price curve, which, on the cost curve, like electric vehicles coming out of China for like 15,000 euros which is like half the price of what you would expect normally for such vehicle, which is absolutely crazy. But look, I just want to react on something you said in terms of like you don't back anything with a green premium, or you don't back anything that relies on subsidies. Are there any other rules as part of your business? And I'm asking for myself. I'm starting to invest. What should I look for?
Yeah. Well, I mean, that has always been core. I mean, Sierra's background is in economics. So if it can't win on price and performance standing on its own two legs, we don't see it dominating a large global market for energy or materials or anything else. So that is core. It's important to not break physics. So have to, clearly abide by the rules of physics. We like to see that there is a continuing cost and performance advantage that will accrue and compound over time, rather than sort of a one-off, say, molecule that's really good today, but someone could invent a better molecule tomorrow, right? So another way to think of that is sort of a foundational, enduring advantage that grows as you grow. You get to even more economies of scale. You can take advantage of other cost down trends that are happening in the world, like what we spoke about with batteries.
Does that mean that you have to only invest in the technology layer? So going back to the molecule, for example, would you rather invest in the tech that enables to create a lot of molecules rather than the molecule itself? Is that the way to put it?
Part of the role of VC is you also sometimes break your own rules. Um, but I think we think about, how is your company going to be not just surviving 10 years from now and relevant, but in a position that's even better. And so you need to have some engine by which you could continue to innovate. Software companies, of course, do this, right? There's no piece of software that's it's globally renowned and driving innovation that hasn't changed in 10 or 20 years. I mean, you constantly need to innovate. We invest in software, but also, of course, physical products. So if you just have a hardware design and that's locked, and you're not really innovating on it or a molecule ever in your business, you are going to be overtaken. So we look for teams that can innovate, and that they're building in a space where there's a lot of headroom for innovation. There's new doors of opportunity opening up. Um, so, for example, in molecules, chemistry, that might be a machine that is an N of one machine, meaning it can do things that no other sort of paradigm can do. Maybe by coming up with some innovation that doesn't rely on fossil, where a certain chemicals manufacturing has always been driven by fossil, and now you get more precise control, you get 99% lower energy use, faster turnaround time. You're now positioned to make lots of things off that machine that all inherently, save steps, save energy, save capex versus the fossil-based incumbent. You're going to have a continuing advantage that also continues to grow as automation grows and the electrification stack grows.
All right, coming back to your thesis, because you've mentioned already a little bit of what you're looking for. So you mentioned advanced materials. I'd be curious to hear from you. Where is the opportunity going in that trend? So, I mean, obviously, we are already chatting a little bit about the machine and everything, but like, where do you look specifically beyond the team? I know you love the team, but
Yeah.
beyond the team.
Happy to talk about technology. So, um, we think a lot about what are better, cheaper, faster ways to make and use energy, materials, and machines. So making all the materials, the key materials that go into making cars and batteries and everything else that runs the world, not just a better process for making steel and rare earth metals and lithium, but can you achieve better results even? So it's not just a cheaper, fewer steps, but can we actually create better materials too? So we're looking at innovation on every part of the stack because if you've got alloys, metal alloys that are stronger, better steel alloys, better ceramic alloys, you can do things with those, and you can make airplanes and cars and batteries that surpass anything on the market today or anything that any other company can deliver. That's really exciting to customers because now they can store energy longer, they can store it on a smaller footprint, they can have more range on their EVs that work better in the cold and are fire safe. And so you're getting all these properties. It's not just about cost. I mean, cost always has to be positioned to win. But if you can also offer things that, your drill bits will last twice as long because they're a pure, stronger alloy that's less brittle, that matters to customers. They don't have to stop drilling their geothermal well 4 times a day, and they can stop 1 time a day or 0 times a day. And that directly flows through to cost and performance advantages that far exceed the actual product that you're selling. So let's talk about a couple examples because that's all very high
For
level.
sure.
But so we backed a company called Lita, based out of Santa Barbara, that has a new way to make alloys, just fundamentally new way to make alloys. So when you make an alloy, you're taking metal powders and you're just sort of mixing and melting them together. That's a huge portion of the way we use metals in the world. Is they're mixed to get the right properties that you want, and that's been true for thousands of years. We've even named civilization eras after what kind of metal we figured out how to make, the Iron Age, the Bronze Age. So it's clearly very important to what we can do in civilization. And we've always done it the same way. Fundamentally, we've always burned some kind of, fossil or biomass source, burn something, and then crudely sort of put the heat and direct it towards the metal to melt the metal. It works. It doesn't work very well. From first principles, it's not the right way to cook metals. You're going to burn some, you're going to undercook some, and you're never going to get perfect consistency or quality. You get a lot of defects. You get a lot of unusable metal. It's always going to be imperfect and imprecise, and it always has been. What Lita can do is they don't obviously burn fossil fuels, but they actually don't burn anything. They use electricity. They use high-powered energy waves to perfectly and precisely make alloys better than they've ever been able to be made in history. And it's cheaper and it's faster. So that's really exciting because that's potential to remake a huge portion of the world's material base and to make it better and to make it decarbonized. So we really like that kind of thinking about replacing a fossil fuel with something that's inherently cheaper and better. Customers are never going to go back to a more brittle, poor performing, more expensive material.
I love the framework you have there, which is it's been produced the same way for 1,000 years. No one has touched it. That's where the opportunity is. I think that's quite an interesting framework to have when we look at some of those more industrial play, right?
And you might ask why now? Well, we have a much better toolbox than we had in the Bronze Age or the 1850s or the 1950s when a lot of our industrial processes were made. We have advanced compute. We didn't have that in the 1950s. We didn't even have the level of sort of AI-enabled automation that we have now 3 years ago. So every year, certainly every decade, new tools either become invented and commercially available, or they become next level cheaper. And that enables founders to really rethink how we do things from first principles and come up with better ways. And they're leveraging the full toolbox of technological progress. So that's not just electricity, but all the things you can do with it. You can make, X-rays and high-powered microwaves and all the sensors and all the capabilities. You can use UV light. You can make materials transform using the entire EMR spectrum and all the tools and compute that we have. And that full toolbox is not how we came up with most of the processes we do in the world. So it's a massive opportunity. It's really exciting.
Yeah, I remember from an episode from last week, someone from Energy Impact Partners told me that the nuclear reactors, the first one, came out before the computerized spreadsheets. And I was like, ooh, interesting. Like, would I trust something like that today? But it's true. Like some of the stuff that have been around for decades and way before we had compute capacity.
Yeah.
Um,
And, compute, of course, applies across everything in the economy and all activity, but there's also some sort of less obvious ways that progress in one area of technology is now opening up doors in a completely other area. So, we've all heard in the news probably a lot about rare earth metals these days. They're critical for making, the most high-performing electric motors that go into everything from cars to jet planes, and lots in between. And, the ores for rare earth aren't actually that rare, but the refining capacity is almost completely concentrated in China. And the Chinese process is inefficient. The technology for refining rare earth metals, it's fossil heat-based separation, and it's so imprecise, you have to run the process about 100 steps, 100 times. So it barely even makes any money, and you get a lot of polluting solvents out. And um, we backed a company based in the US called Alta that has, from first principles, completely different way to make rare earth metals. Obviously, no fossil required, but also no heat. What they actually use are proteins that evolved in nature to specifically bind to rare earth metals, and only rare earth metals. And so they use these proteins basically as a filter to, with very high specificity at room temperature and pressure, refine rare earth metals. It's low capex, modular. They can run this process cheaper than the Chinese process. So that's really exciting, right? That's progress in biotechnology that's now impacting how we produce some of the most important metals in the world. So there's a lot of overlapping innovation coming from different areas that's really changing what's possible.
Going back to what you said on like critical minerals, for example, and critical metals, yes, we hear a lot about it these days. It's all over the news. Everybody talks about it. From a first principle and VC perspective, I'm like, if everybody talks about it, the opportunities are already, taken by everyone else, and I have to find the next new stuff. Is that an accurate framework to think about investment, or is it just because that it is really important that we fix it on the critical metals, and as such, the opportunity remains massive?
Yeah, it's a great question. Another way of thinking about that is this a short-term hype and overreaction, or is this a long-term trend based on creating real and necessary foundational value? And I do think it's worth stopping and thinking about that when there's a lot of buzz and a lot of hype and a lot of people kind of rushing to invest in the sector, particularly if it's one they didn't really think or talk about 2 years before. I will say for us, the core materials that drive progress from energy to metals on up to the machines and the operation of those machines that run the world, that is very foundational to what we have always invested in and how we look at creating long-term value. I think an analogy to what's happening right now might be the rush to build out data centers. And I do think investors, I mean, that's less VC money building out those data centers, more infrastructure investors. But what parts of this investment opportunity endure and look good by the numbers? They have good margins. Those margins grow over time. And what doesn't? I'm not an infrastructure investor, but those chips, the GPUs depreciate on a 2-year timeline. You're talking, many, many hundreds of billions of dollars of infrastructure investing that tends to not yield growing margins over time and venture capital scale returns. So I would sort of separate the unit economics of a business that is building infrastructure versus the unit economics of a business that is building the tools, the flexible software tools, or the applications of those tools that run on that infrastructure. So I don't think AI is pure hype. There are limits to what LLMs are likely to be able to do, but I don't think we've yet maxed out and hit those limits. And certainly there's a tremendous amount of innovation and design space to explore. where LLMs are not just able to help people navigate language and text, but all kinds of other information about medical records and scientific data. We see a lot of companies, and in our portfolio as well, that are using AI tools to improve their rate of innovation and learning and generation of ideas to test and try, whether that's a new battery design or a new molecule design. So I would really think about where's the long-term value going to come from, and if you're a venture capital investor, where's the venture scale returns and growing margins over time, and headspace for innovation. Data centers are tweaking their designs and innovating, but it's certainly not the same pace of innovation as the software that runs on data centers.
Look, I could have that discussion for much longer on different spaces of investment, but there's one last thing I want to talk about very briefly. You obviously have an interesting background as an investor because you come from research, you have spent some time in research, building startup as well. By the way, I wanted to mention that I love Get Around. Just saying, just curious how that shapes your investment approach differently to other people because you have this background. What are some of the lessons learned from those different experiences that shapes your investment point of view?
I've spent my time pipetting in the lab. It's probably not what I'm best at, and a good portion of our team also brings PhDs and lab level work in mechanical engineering or working in wet labs. I think it's really helpful. I mean, one, you have empathy for what the founders are going through in terms of trying to innovate it with the physical world and setting up labs and running tests and the constraints on time and resources. I think you're much better able to be a partner to them, to help them, think about how to be scrappy while still getting access to the best quality resources in the world, whether that's, outsourcing testing to a multi-million-dollar microscope at a national lab rather than trying to buy one yourself. I think you get a real appreciation and respect for the timeframes that are inherent in building in the physical world, testing cycles, quality control, coming up with hypotheses and modifying your protocols. I think it's also really helpful that I and many members of our team bring experience as operators and entrepreneurs trying to execute on technical ideas in the real world environment, because you also understand, all right, where can we push things faster without sacrificing on quality and on rigor, on scientific and technical rigor.
Yeah, I love that. I will let you go because I know your agenda is quite full. But before we do that, I'll first say that the link to the Voyager Venture website will be in the description, the link to your LinkedIn profile as well. My last question to you is, who's the next person that I should interview on this podcast that invests in European climate tech? Who's the person that you respect the most?
We have a lot of respect for a lot of folks. Well, I see that you've already had Hampus on your show. No surprise there. Hampus and his team are wonderful. Have you ever spoken with EQT?
No, never.
Okay. They are not solely climate or industrial or energy investors, but they actually do quite a lot. I'd be glad to put you in touch with someone we respect there.
Sounds good. And listeners, if you enjoyed this episode and if you enjoyed the show, don't forget to subscribe, comment, and like on Apple Podcasts, Spotify, and YouTube, or share it with a fellow climate investor or founder. Thank you so much, Sarah.
Thank you, Hugo. This has been great. Really appreciate it.